Hey guys, Tom here from Investing with Tom, and today I want to talk to you a little bit about inflation. What is it? Why is it important? And what can you do about it? So, what is inflation? Essentially, in a healthy economy, what inflation is it's a steady sort of increase in the cost of goods and services out there in the world. So, it happens in a healthy economy. There are situations around the world where you'll see, in Zimbabwe, for example, you'll get things like hyperinflation, where the currency is growing or the price of goods and services is growing at a ridiculous rate, and the purchasing power of a dollar decreases rapidly over time. But in a normal, healthy economy, we tend to see inflation rates annualized of anywhere from about 2 to 3%. That's sort of the average over the last century or so, is around that 3% rate. And what that means is that every year the price of standard kind of products that you'll be purchasing will go up around 3% on average. So if something costs you $1 this year, the next year it's going to cost you around $1.03. That's what inflation is. And now we'll go ahead and talk about a little bit why is it important. So the reason that inflation is important is that essentially over time it decreases the purchasing power of your money. So if goods and services are becoming more expensive out there in the world, it actually penalizes the typical kind of saver. So if you're saving money and you're consistently putting that money away just into the bank, earning say 1% interest a year, for example, the purchasing power of that money is actually becoming less and less over time. And that is one of the reasons why cash is typically quite a poor investment over time. There's a time and a place for holding a lot of cash in a portfolio, but generally speaking, cash is a bad investment. If you hold cash for around a period of 30 years, the purchasing power of that money will actually drop by about 50%. So in 30 years, you're going to, something that cost $1 is going to cost $2. In another 30 years, it's going to cost $4. And in another 30 years, it's going to cost $8. So things are becoming 3% more expensive per year, and the purchasing power of your dollar becomes less and less powerful. If you save $1 today, in 30 years, you're going to be able to buy you're going to need twice as much money to buy the same thing. That dollar is only really going to be worth around 50 cents in today's money in about 30 years' time. In another 30 years, it'll only be 25 cents. And in another 30 years, it'll only be 12.5 cents. So inflation is very, very powerful at penalizing the saver. So you've got to go ahead and do something about it. So let's talk about that next. So usually when you hear people talk a little bit about the best way to sort of combat inflation, they'll tell you that the best way is actually to invest in companies. And I tend to agree with that logic. Sometimes you'll hear people say invest in things like gold. There's no more gold being created in the world. Gold is kind of a store of value. And over the very long term, that does tend to be true. But I'm much prefer investing in companies. So the best example of that I generally tend to think of with trying to combat inflation is investing in something like Coca-Cola. So if you want to go out and buy a Coca-Cola today, let's say that costs $3. In 30 years time, that's going to cost $6. If you put your money in the bank and you're a consumer of Coca-Cola, your money is becoming less and less powerful over time. But if you're an investor in Coca-Cola and you own the company, when inflation comes along, essentially you just push your prices up. That's all you really need to do to combat inflation. If you price something at $1 this year, you can price it at $1.03 next year, and you're kind of good to go. That's all that you really have to do as a company. And in periods of rampant inflation, if you're a company that has a big competitive advantage and a really strong brand in the market like a Coca-Cola, people are going to continue to buy your products. So that's a way that these companies can kind of get around inflation. It's not really a huge issue for them unless there's things like hyperinflation going on and prices are just going crazy. That's generally kind of the best way to go about it. So in terms of what you can do in practice, I definitely look at investing in companies that have really strong moats, And that's one of the key principles that you should be looking at in all your investments. So the things I tend to look at, definitely follow the Phil Town, Warren Buffett style rules, where you're looking for a company that first you can understand, a company that has a moat or a competitive advantage in the marketplace, a company that has really good management, both with integrity and talent, and then a price that offers you a margin of safety when you go into that investment. So those are all things that you should be looking for. The moat is a massive one when you're looking to combat inflation, and that's a little introduction to inflation in general. So hope that helps. If you enjoyed the video, drop it a like. Love to see you subscribe as well, and love to hear some of your thoughts on inflation and what you're kind of doing out there to combat it. So that's me. That's all for today, and I'll see you next time. Cheers.